We're halfway through 2025 and US stocks have recovered their losses, but that means we're back with US stocks looking very expensive as we've reinflated the stock market bubble. Or have we? Is this the new normal where high valuations here to stay? In this video we'll look at those 2 points of view and I'll end with what I think. This video is sponsored by Lightyear, a UK investment platform with low and transparent fees that offers stocks, funds and interest on uninvested cash. Let's begin with where we are right now. In terms of valuation, at least for the US, we're pretty much back where we started the year. In other words, US stocks look very expensive, particularly those large caps. So here you can see three slices of the US market: the S&P 500, which is large caps and mega caps, the mid cap index, which is the S&P 400, and the small cap index, which is the S&P 600. And while the large caps are looking very expensive, the mid caps and small caps are looking relatively very cheap. And really that's been the case since 2020, with large caps really surging ahead in terms of valuation, and mid caps and small caps languishing far behind. Robert Shiller's cyclically adjusted price to earnings ratio is a measure which is used to detect bubbles. Historically it's been very good for that, and at the moment it's looking very extreme indeed. So here you've got kind of smoothing over a business cycle, and you can see that valuation looks very extreme. In fact, we're at the 98th percentile. It's only been more expensive 2% of the time over the last century. Now, if we adjust for interest rates, we get the excess cape yield measure, also from Robert Shiller, and here expensive is at the bottom of the graph rather than the top. And you can see that again, the US is looking expensive, not as expensive relative to history. Here it's only the 78th percentile, but still, the US is looking expensive by this measure too. And while we're at it, why don't we throw in two more valuation measures? If we look at price to sales, that's the price of the index divided by the revenue which stocks have generated. That's also looking very extreme, as is Warren Buffett's preferred measure, which is to look at the size of the stock market relative to the size of the US economy. Now, some people say instead of dividing by the size of the US economy, because a lot of companies export outside the United States, then this isn't a good measure. But even if you divide it by global GDP, this valuation would still look extreme. So by almost any measure you look at, the US is looking expensive. So what we're going to do next is look at two diametrically opposed points of view that look at this same data, the US looking relatively expensive, and interpret it in completely different ways. Either the US is in a bubble or this is a new normal. Before we go on to talk about that, today's video is sponsored by Lightyear. After meeting their team in London and chatting with Vanda, who leads UK growth, I saw firsthand how focused Lightyear is on building a platform that serves both everyday investors and businesses. Their flexible stocks and shares ISA lets you invest in commission-free ETFs, though fund manager fees and a 0.35% foreign exchange fee may apply, and you can trade international stocks with a maximum fee of just £1. You can transfer your ISA in or out, and they're constantly expanding the range of instruments available to UK investors. If you're looking to invest your business's cash, Lightyear's business accounts follow the same transparent pricing, plus all the necessary accounting documents, a web app for easy access, and multi-user access for you and your accountant. You can try Lightyear using our special code, PensionCraft, the name of our channel, or follow the link in the description to get up to $115 worth of a US fractional share in your general investment account. Terms and conditions are in the description below. And remember, investing involves risk, and the value of your investments can go down as well as up. Now let's turn to our first interpretation of markets, which is that we're in a big stock market bubble. And I'd say the thing that has most people worried at the moment is the concentration in mega cap tech stocks in the US. Almost everyone I speak to is worried about this. Now there is some justification for the worry. So for example, if you look at the proportion of the S&P which is made up by these 8 largest stocks, it's a very huge 30%, almost a third of the index. However, If you look at the actual profits which they generate as a proportion of the total S&P 500 profits, that's only a quarter. And if you look at the revenues, they only make up 12% of the revenues for the S&P 500. So if we look at fundamentals, these stocks are punching above their fundamental weight. People are perhaps overpaying for these mega cap tech stocks. And if we look at the returns of various asset classes, going all the way from equity to fixed income to cryptocurrency, you can see that risky assets sold off very sharply with the introduction of Liberation Day tariffs. However, those didn't survive long. We saw something called the taco effect. Trump always chickens out, as one journalist has called it from the FT. And then when he backed off, risky assets started to recover. And we're now pretty much back to where we started the year for those risky assets. So that's US S&P 500 stocks, it's the Nasdaq, and cryptocurrency has surged. However, what's kind of interesting is that gold hasn't fallen. Gold, remember, is seen as a safe haven investment, and yet many people, I think, are still concerned about what's going on in the US and with tariffs, and that's probably why gold hasn't fallen. Now, you probably noticed another dashed line at the end of this graph, and that shows you when the 90-day respite for US tariffs is going to disappear, and then potentially we'll get another sell-off. So for people who think that the US is in a bubble right now, I think they describe what the markets are doing right now as complacency. There's still huge uncertainty when it comes to US foreign policy and US trade policy, and it's very likely that we're going to get another shock maybe in just a few days or a few hours. We never really know. So I'd say at the moment, global equity markets are very much driven by the whims of the US president when it comes to trade policy. If he says he's going to raise tariffs, then it's tax on and equity markets fall. If he says he's going to cut tariffs, then it's tax off and markets rally. And we never know from one day to the next which one it's going to be. Now, in case you're too young to get the joke about tax on and tax off, let me just show you a brief clip if you didn't live through the 80s as I did.
Wax on, wax off. Don't forget to breathe. Very important. Wax on, wax off. Wax on.
So that was the bubble point of view, but there is an alternative. And perhaps the best way to describe that is as the new normal. So I'd characterize this view of markets as saying, sure, we've been through a rough patch, but essentially the US economy is still okay, and it may be the case that there are structural changes, long-term changes in markets, which actually mean these valuations are here to stay. And comparing valuations with what they looked like a century ago, which is what we do when we look at the Shiller Cape measure, is just not appropriate. It doesn't really apply to today's markets. So what are the justifications for that point of view? I think the first one, and probably the most important, is the shock and awe that we've seen from central banks around the world. Every time we've had a big crisis, whether that was a global financial crisis, a crisis of our own making, you could say, or the pandemic, which was a natural crisis, in both cases, central banks stepped in, dramatically cut interest rates, unleashed new tools of unconventional monetary policy. The Fed was buying high-yield credit ETFs at one point, and that buoyed up markets. It restored confidence, and now markets, perhaps justifiably, expect that if there is another crisis, if equity markets have another wobble, then the Federal Reserve and other central banks are going to step in and pump asset valuations back up. Now, many people call this the Fed put, but it's the idea that the Fed will save the day. Furthermore, if you look at the end of this graph, you can see that after the inflation spike and the concerted rise in interest rates from central banks across the world, we're now seeing central banks cutting interest rates, in some cases like the Eurozone, quite aggressively. Now, we're not going to go back to zero interest rates, but this is a positive for equity markets. Lower interest rates generally is good for growth stocks and for stocks generally. Another structural or long-term change that we're seeing right now is a technological one, with these tech stocks really coming to the fore when it comes to stock markets. And that's partially justified. If you look at how efficient those companies are, how innovative they are, perhaps their valuation is justified. Because if we go back a century and we look at what industry was in those days and what dominated stock markets, a lot of steel companies were very dominant. Now these require a lot of capital, they're very capital intensive. They also have fairly low margins relative to what we have today. And if we compare that with a modern day company like Microsoft, which is dominating the S&P 500, you can see that their biggest expense is people. If you look at their headquarters, you can see that it's actually looking like a university campus rather than a factory. And that's a lot less capital intensive. Furthermore, it's also a lot more profitable. Again, if we break down the S&P 500 into the mega cap 8 stocks, the largest stocks in the S&P, and those other stocks in the S&P, look at the huge difference between the profitability or the margins for the mega cap 8 and the rest of the S&P. We're talking about profit margins of 26% on average for the mega cap 8 versus the rest of the S&P, which is only 12%. I think that's even clearer if we look at these Sankey diagrams, which show the money flowing into the company from top-line revenue all the way through to profit. Notice how if we look at Microsoft, for a revenue of $66 billion, you can see that $25 billion of that made it through to net profit. So that's a net profit margin of almost 40%. Compare that with another US large cap stock, which is ExxonMobil, and the margin's only 10%. So if Microsoft makes $1 of revenue, about 40 cents of that makes it through to profit. That's 4 times as much profit as you'd get for a dollar made by ExxonMobil. There, only 10 cents would make it through to the bottom line. So perhaps high valuations are simply part of this new paradigm in which we've got more profitable companies, more efficient companies, more innovative companies, which is simply starting to dominate this corporate landscape. And that means these higher valuations are here to stay. Another structural change which we've seen in the United States is that we've got a lot more index investing. The message about active managers underperforming got through to the US investor long before it did in Europe and the UK. Now, index investors tend to be very keen on buying the dip. It's worked very well for them this year at least, and it worked very well during the pandemic. In those two cases, the period during which markets dipped was very brief indeed. And if you did buy at the bottom of the dip, you did very well. So these price-insensitive index investors who are willing to buy the dip and who aren't so sensitive to valuation are another reason why valuations are now higher. They create this steady stream of demand for stocks, and that's going to push up valuation. Now, if fixed income or bonds were to provide an alternative to stocks and generate a good rate of return to compete with stocks, well, maybe that would suck some of the wind out of the sails of the stock market. But for example, if we look at the UK market right now, the FTSE 100 has a dividend yield of just under 4%. And if we compare that with the UK gilt market, that 4% exceeds the yield of several short-term UK bonds. Certainly the ones which you'd buy and hold to maturity up to that 5-year point. Plus, unlike fixed income, you're also going to potentially get some capital gain to go with that income. So I think yields at the moment just aren't attractive enough to provide an alternative to stocks. And that may be another structural reason why stocks are doing so well. And finally, it's not true to say that all markets are expensive. Even parts of the US market are looking cheap, like mid-caps and small caps. Plus, there's a whole slew of value stocks in the US which are still unloved and looking very cheap. And if we look at forward price to earnings multiples across different countries, there are many countries which are looking quite cheap relative to the US. So for the global index investor, I don't think it's true to say that all stocks are expensive. There are still some real bargains out there. So there we have it, 2 points of view which are completely different to one another. And I have to say, personally, I think that the most convincing one is the bubble argument. I think that US valuations are looking expensive right now. I think given the uncertainty that we see in markets, valuations are simply too high in the US. Plus, I think the case for US exceptionalism is looking more difficult to make nowadays, after DeepSeek and given what's going on with US trade policy. So whichever of those 2 points of view you hold, then it's important to understand that holding money back from markets is usually a mistake. Usually it's best to carry on investing whatever happens. So create an investment plan and stick with it. And it's got to be a plan that works whether bad things happen or bad things don't happen, because eventually there will be a pullback. So it's simply a matter of preparing for that and acknowledging that you won't be able to predict it. But do tell me in the comments which of those 2 points of view you adhere to. Do you agree with me that we're in a bubble, or do you think this is the new normal? And don't forget the special offer from the sponsor of today's video, which is Lightyear. If you use our special code, which is the name of our channel, PensionCraft, then you could get up to $115 worth of a US fractional share in your general investment account. If you want to see the terms and conditions for that, they'll be in the description below, along with a link for that offer. And, as always, thank you for listening.